Hello, this is Ilan Awerbuch with Unitrust in San Diego, California, and this is Mortgage Watch for Wednesday, February 17th. Well, this is part two of the series I began last week called Are Big Banks Bad? And as I said last week, and I'll repeat again, the purpose of this seminar and this little tape series is not to bash big banks, but to explain what went wrong and where I think we will continue to have problems if we don't take steps to rein in the blurring role that big banks play in our society. Last week I touched on several issues and I'll recap them briefly. Who are the big banks? They are the banks that have been considered too big to fail. They are national banks, what were Wall Street firms that are now actually banks with banking licenses, the two that have remained behind, Goldman Sachs and Morgan Stanley, as the others have disappeared or been swallowed up by other banks, and also regional players to some degree. Now, traditionally, we think of banks as depositories. They're a place where you put your money and you have checking and savings accounts, etc. And they're lenders. They lend money, or used to lend money. They still lend money to some degree, but very little of their own, and very little of items that they can't just pass on to Fannie and Freddie Mac. You may have seen it, you may have heard about it. Businesses are having a hard time borrowing money from banks. So their role as lenders has kind of diminished. And why? It's because the roles have blurred. Sometime back in the 90s, banks became very, very big as securities underwriters and sellers. It's very, very lucrative to put together securities, which are mortgage and financial instruments of different items. They also have a secret role as equity investors. When I say secret, it's because many people don't realize how much money really sits in some of these banks' private and equity type groups. Last week it came out that Goldman Sachs Private Equity Group is the largest in the world. They have billions of dollars to invest in companies and take leading roles in controlling what goes on in commerce. Now, I'm not trying to say it's a cabal of interest and so on, but it's important for people to know these banks have so many overlaying and interlocking roles that it sometimes blurs their role and what it is that they do. It's no wonder that the government stepped in to protect them and keep them from failing, because that failure would have been catastrophic in many, many areas. Well, today's topic is the history of subprime lending, or how banks became involved and screwed up what was a pretty simple business. Once upon a time, subprime lending, which is loans made to people with credit issues, people who don't pay on time, people who don't keep good track of their bills, etc., that was the province of these storefront lenders. Many of them were owned by giant companies with names like Transamerica, Ford Consumer Finance, Household Finance, General American or American General, and companies like that. They existed for many, many years, since the 50s. Well, Wall Street began to realize that they could have an inroad here and actually make money, lots of money, by stepping in and making loans to subprime borrowers. Well, subprime rules were very, very simple. Borrowers needed to have equity. Equity, as we have said, is the number one determinant of someone's ability and willingness to make a payment. The more that somebody owes against their property, the less likely they are to pay if things get to be in trouble. The other thing was some form of income documentation. That could be a pay stub. That could be bank deposits or a history of making bank deposits. That all lets us know that the borrower has a good likelihood of making the payment. So in getting involved in this field, the banks, Wall Street firms, began to securitize. That is, they began to put these subprime loans in pools. And they began to realize that in putting these pools together, they could sell these things to many different investors, people who normally would not be involved in lending or getting involved in making loans to these subprime borrowers. These large securitizations were supposed to spread out the risk. But what is the risk is an answer that really nobody had. And the rating agencies, Standard & Poor's, Moody's, Fitch, they're the ones that are supposed to announce to investors what the risk of any known security is. Well, they didn't know. They didn't know what was going into these products. So they would call up the securitizers, the banks and Wall Street firms, and ask them, well, how risky is this investment? And they would be told, it's not risky at all. We've done a great job of underwriting it. So this thing had a AAA rating. AAA rating means that all kinds of people can invest in it. But nobody really knew the risk. The other problem was the ticking time bomb that was created. Once upon a time, subprime lending was fixed rates. Borrowers knew what their interest rate would be, but Wall Street came up with a way to take it into arms, that is, adjustable rate mortgages. They start out very low, and in 2 years' time, they'll skyrocket, in some cases double. We'll see later on how this also trapped a lot of prime borrowers. It's come into play that a lot of prime borrowers were kind of pushed into these subprime loans because they had very, very low start rates, and they also were set up in a way that made them very attractive. Now, once upon a time, as I mentioned, there were guidelines. But Wall Street started to figure out that, well, guidelines are really just something that get in the way. So in addition to no need for loan to value, because loans were being made up to 100% of the value of the property, there was no income documentation, because after all, we don't really need to know what someone's income is. Well, that might work if you have a perfect credit borrower, but these are subprime loans. They're being made to borrowers who have a history of not paying on time. It's what we call the layering of risk. We take no loan to value, high loan to value, that is no equity. We combine that with very, very poor credit scores, a history of not being able to manage credit, and we add to that a lack of any kind of income documentation. So we can't say the borrowers have the ability to make their payments. You put all that together and you have multiple risk layers. Well, when everything hit the fan and it all fell apart, what did Wall Street say? Well, they said the devil made us do it. It was mortgage brokers. They're the ones who gave us all these loans, but they're omitting one giant fact. Wall Street is the entity or the banks that created these subprime vehicles, that created the securitizations, that sold them to school boards and to governments far and wide. And what really led the whole thing to implode? Well, it might have not have imploded if values kept going up. But at some point, home values broke. Home values stayed flat and then went down. But the real problem isn't that. The real problem is that the layering of risk in these subprime loans was a time bomb that would have caught up with things whether homes had gone up in value or not. Well, I hope this was informative for you to understand what the subprime crisis is based on. Next week, I'll discuss how after subprime, the banks and Wall Street firms started tweaking with prime loans, taking again something that had a pretty simple guideline and playing with it so that they could make more money and develop securitizations on these products, sell them to lots of people and make more money. We'll see how all these different factors contributed to the perfect storm of the financial debacle that we're trying to struggle through now. Well, I thank you for listening through to all this, and I look forward to speaking with you next week. This is Ilan Awerbuch at Unitrust in San Diego, and this is Mortgage Watch.